Hello and welcome. Let's talk about investing for a minute because I want to share a story. Now, back in 2011, I graduated with a degree in business and finance. And before you go there, yes, I am that old. Anyway, back then, my mother had invited family over to celebrate the occasion, and you could see the happiness on her face of her son achieving this first major milestone of higher education. Now, I was sitting at the dinner table when my uncle asks, "So, now that you're a finance expert," which clearly I wasn't, "what do I put my money in? Give me some sure shot winners." And frankly, at that time, I wasn't able to answer this question. Now, it wasn't because the question was complicated. No, I'm pretty sure all of us at some stage have gotten a question like this. But it was because I did not have a clear cut answer. And I'll explain why. You see, my uncle is very old school in his investing mindset. He had earned most of his money through real estate, earning stable rent, as one does in the old world, and topping it off with capital appreciation. And the fact that he made a killing in real estate, he kept his distance from the markets because to him, they did not make much sense. Now, it has to be said that he lives in a place where financial markets aren't mature as well. So that is also likely to contribute to his averseness. Now, coming back to the story, I could have responded to my uncle and said the usual stuff like, it depends. What's your risk tolerance? Or something like, well, we tend to look at ratios to invest, such as the price to earnings ratio, EBITDA margins, etc., so on and so forth. But let's be honest, it would not have landed. And the reason why I'm sharing this story with you is because for the better part of a decade, this experience stuck with me as well. As somebody who wasn't native to a place where financial markets work efficiently, and by efficient I mean moving based on fundamentals, demand, supply, etc., I myself struggled to put the investment knowledge to practice without exposing myself to risks I did not understand. So, fast forward a few years, further specialization in finance to figure out my investment journey and some collective wisdom, I came across a starting point, which, to be honest, I'm pretty sure you must have heard it as well. And it goes something like this. Rather than overwhelming myself with where to begin, why not keep things simple? And what I mean by this is that instead of inundating myself with volumes of analysis to pick winning investments, why not just start with investing in the market in the first place? Now, that is a perspective I put forward in the Starting Your Investment Journey piece on Quantificate. And I strongly recommend you read through it. I'll post a link in the description below. But to remain true to the Quantificate mission, in this piece, I present some analysis that helps inform why starting off with investing in the market may be a good idea. But since you're already here, let me give you the TLDR version. But I strongly suggest you read through the full piece though. So, in the TLDR version, number one, your first step into investing doesn't need to be daunting. Start simple by investing in the market, and I'll go over what I mean when I say market in a bit. Number two, the power of compounding is your best friend. If you're unsure about what compounding is, in simple terms, it means getting returns on your returns, with a caveat being that you reinvest your returns. Now, the market has a long and established history of compounding returns, and we calculate this as the CAGR, which is the compounded annual growth rate. Number three, which is an extension of number one, and it goes something like this. You do not need to try and beat the market for decent returns. In fact, if we look at historical data, the long-term CAGR of the S&P 500, which spans roughly 100 years, is close to 7% per year. And if we look at a more recent block of time, i.e. a 20-year look-back period at the time of this video, we see that the CAGR is roughly 9% per year. Now, to put this into perspective, an investment yielding a 9% CAGR means that you roughly double your money every 8 years. Is this decent enough? If not, here's another fascinating fact. If you had invested $10,000 in the S&P 500 in 2015, by 2025, you would have had more than tripled your money, netting in roughly $34,000. Now, before I proceed, I'm going to take a page out of Andrew Chang's book, and about that, Andrew Chang from CBC, that is, and it goes something like this. Repeat after me. Past performance is not and should not be indicative of future performance, which in simple terms means that one should not solely rely on past returns to inform oneself of future potential. But, and there's always a but, as ironic as it sounds, when we look at trends in past performance, and that too sustainable trends, it helps us better inform ourselves of future outcomes in the absence of any additional information. Now, I know it sounds convoluted, and take from it what you may, but I would urge you to remember one thing. Every investment comes with its level of risk, meaning that this is a fancy way of me saying that enter into investments with your eyes open. Number 4, which is closely tied to the previous point, and that is that many funds that are run by specialists normally have a mandate to beat the market, because that's how they justify to investors to invest with these fund managers rather than go at it on their own. But as we go over the data in the article, we find that a significant portion of these funds that do active stock picking have not consistently beat their benchmark, and the benchmark being the market they rate their performance against. Now, of course, this varies from region to region, but the overarching observation is that the majority of these funds often underperform against their benchmark if we look over a consistent term, 3 years, 5 years, and so on. And the funny thing is that these fund managers are, like I said, specialists that are paid to beat the market to justify a higher management fee. So there's that. Number 5. Now that we've touched upon risk a little, I think this is the perfect time to discuss how passive investments diversify risk. Think of it this way. If today you had put all your money in one or a handful of stocks, the chances of those companies going to zero, worst case, would be higher than, say, the entire market going bust. Now, this does not mean that the markets may never go bust, but I hope you understand that the risk of investing in the market are watered down because the market normally has some winners that cushion the impact of others that may perform poorly. And this is why we call this is what we call the risk-return trade-off, and you most likely will come across this in your journey. Now, let's take an example. If you had invested in Tesla a decade ago, or say Nvidia 2 to 3 years ago, your stock may have gone up multiples rather than a few percentage points. Now, that means that the investment upside for you would have been huge. And if you compare that to, say, investing in the S&P 500 or NASDAQ, the return from these benchmarks would have been relatively muted. But as we've already discussed, had it been the other way around, i.e. a doom and gloom scenario, where the economy had not performed well, the impact from investing in the market would have been considerably cushioned versus if you had put your money in a few businesses that could have closed shop overnight. And that's the key theme I want to leave you with, which is the fine line between sustainable investment for wealth growth versus aggressive maneuvering, and sometimes speculating to score a huge payoff. As with many things in life, money matters are sensitive, and there needs to be a level of care and caution that should go hand in hand. Lastly, on to number 6. The article also talks about some basic investment best practices that you can look into as well. Now, if you've gotten this far, I want to thank you, first of all. But the fun isn't over yet. I have also created an app that goes into some analysis of different markets I allude to today. The app also has a basic portfolio optimization tool for you to play around with. There's also a how-to video where I talk through how I would ask you to use this app and also how I would look at the output from this app. So feel free to play around with it. But first, some parting remarks. The Quantificate ethos is to impart educational material only. I am not a licensed investment advisor or professional for that matter. I'm just a regular guy with an education and experience in finance and business. I have not made millions or even $1 million for that matter through investments. I am just somebody who is also on his journey to build wealth for my loved ones and generations to come. In simple words, I'm here to provide a perspective only, to inform you with an additional point of view that I hope will be helpful in your journey. With that said, thank you once again. I look forward to seeing you over in the Personal Investment Planner app how-to video on the Starting Your Investment Journey page. And most importantly, have fun playing around with the app and ping me, of course, if something breaks. Cheers, and I'll see you in the next one.